Welcome back to MarketSnap, your daily market rundown. Today's session had a little bit of everything: a historic bond market move, a brutal tech sell-off, and a few bright spots that are worth your attention. Let's get right into it, because the story of the day starts before the opening bell even rang. We're seeing a global bond rout that's pushing long-term yields to levels we haven't seen in nearly 2 decades. That's the kind of move that ripples through every asset class, and today it hit stocks hard. The major indexes all finished in the red for a third straight session. The S&P 500 slipped about 0.7%, while the Nasdaq took the brunt of the selling, dropping 1.3%. The Dow was the relative outperformer, down just 0.2%. You can see the pressure was broad-based, but tech was clearly the epicenter. The Nasdaq's drop was driven by a sharp reversal in the semiconductor space. After a strong run, chip stocks got hit hard. The Philadelphia Semiconductor Index fell over 5% as investors took profits and reassessed the AI trade in light of rising rates. And it's not just the tech sector. The S&P 500 is now sitting about 1.6% below its all-time high, and the VIX is creeping up, closing above 15. It's not panic mode, but you can feel the anxiety building. The market is starting to question how long this AI-driven bull run can last with bond yields where they are. The big story today was the memory chip sell-off. We saw SanDisk, Seagate, and SK Hynix all drop around 9%. Micron wasn't far behind, falling 7%. This is a group that has been on an absolute tear. Some of these names are up hundreds of percent over the past year, so a pullback was probably inevitable. But the speed and severity of today's move caught a lot of people off guard. But it wasn't all red. Healthcare was a safe haven today. Eli Lilly jumped over 3.6%, Johnson & Johnson gained 3.3%, and AbbVie was up 3.4%. When you see money rotating into defensive pharma names, that's a classic sign that risk appetite is shrinking. Let's talk about some of the individual movers. Nvidia was down over 2%, and that's a name to watch because it's become a bellwether for the entire AI trade. Apple was actually up 1.4% after announcing changes to its European App Store fees to resolve an antitrust dispute, and Intel fell over 6.5%, continuing its volatile run. In terms of volume, Nvidia was the most active stock again, with over $5.3 trillion in market cap. SpaceX was also heavily traded, down about 2%, and we saw big volume in names like New Holdings and Nokia, which were both lower. Zooming out to the weekly picture, the memory and storage names are still the biggest winners. SanDisk is up over 31% for the week, Western Digital is up 17%, and Seagate is up 15%. These are incredible moves, but today's pullback is a reminder that what goes up can come down just as fast. On the flip side, we've got some notable losers for the week. Twilio is down 9.5%, JD.com is down over 9%, and C Limited is down 8.8%. Broadcom has also pulled back nearly 8%. It's a mixed bag, but the trend is clear. Investors are rotating out of high multiple growth names. Looking ahead, we've got a busy earnings week. Home Depot reported this morning and beat estimates, but noted that shoppers are choosing smaller projects. That's a telling sign about the consumer. We've also got Lowe's, Target, and TJX coming up later this week. And of course, all eyes will be on Nvidia's results next week. You can find exclusive earnings transcript summaries on MarketSnap to get ahead of these reports. Sector-wise, energy has been the standout performer this week, up nearly 2%, driven by rising oil prices. Healthcare is also holding up well, but the consumer discretionary and communication services sectors are lagging, which tells you that the market is getting more defensive. The worst performing sectors this week are communication services, consumer defensive, and consumer cyclical. This rotation away from cyclical and growth names toward defensive sectors is a classic late cycle move. Now, let's talk about the elephant in the room, the bond market. The 30-year Treasury yield hit its highest level since 2007, touching 5.33%. This is a massive move, and it's being driven by a few things: concerns about government debt, inflation fears, and the massive borrowing needs of the AI build-out. Some strategists are calling it the return of the bond vigilantes. This is a critical development for long-term investors. Higher yields mean higher borrowing costs for everyone, from the government to corporations to consumers. It also puts pressure on stock valuations, especially for growth companies that are valued on future earnings. The 10-year yield is approaching 5%, and if it breaks through that level, we could see a more significant market correction. Adding to the uncertainty is the geopolitical situation. Oil prices are rising as tensions between the U.S. and Iran continue. Brent crude is trading above $90 a barrel, and there are concerns it could head toward $100. That's feeding into inflation fears and putting additional pressure on the bond market. So what should a long-term investor do with all this noise? Well, Bank of America's latest fund manager survey shows that investors are still very bullish on stocks, but they're also starting to worry about bond yields. The survey shows cash levels are low and equity allocations are high, which historically has been a contrarian signal. One interesting data point: Bitcoin whales have been accumulating. They've added about 43,000 Bitcoin over the past 60 days, worth roughly $2.75 billion. That's a sign that some big players see value in crypto at these levels, even as the macro backdrop gets more challenging. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in. If you found this helpful, make sure to like, subscribe, and hit that notification bell so you never miss a daily recap. And for deeper dives, check out our exclusive SWOT analyses on MarketSnap. We'll see you back here tomorrow for another look at the markets. Until then, stay informed and invest wisely.